Good morning. Happy New Year. I'm so sorry for the delay. We had a little bit of a technical delay, but welcome to Good to Know Talk Series, where our focus here is to provide financial strategies and tax tips to help grow your business and save on taxes. We understand that business owners are on the move and you need to know how information applies to your personal business. I'm your host, Janine Kong, and owner of Smart Tax and Business Solutions. I am a certified tax strategist and enrolled agent. I help you pay less tax through proactive tax planning. Just a quick note before we begin. If you have any questions during the presentation, you can type them in the chat box on your screen. And at any time, you can also email us at info@smarttaxhawaii.com. Let's see. Sorry about that. Let me. Okay. So over the holidays, Congress brought us a gift, or perhaps you might see it as they brought us some coal. But the Tax Cuts and Jobs Act is the biggest tax bill in 31 years. And while it may look like 503 pages of mumbo jumbo to you, there really is reason behind all that rhyme. So there is a lot in this bill, but today and next week, I'll be focusing on the business portion of the bill. I'll try not to get too technical, excuse me, but there but there are a lot of details that business owners need to understand so they can see the impact on their business taxes. So the main focus with this bill is on cutting corporate tax rates. Our old maximum corporate rate of 35% really was one of the highest in the world, and Congress thought it made us less competitive internationally. And that's not just partisan rhetoric either. While the act passed Congress on an almost straight party line vote, lots of Democrats actually support the goals of corporate tax reform. Barack Obama proposed cutting the top corporate tax rate down to 28%. Now, that's not as much as the new law cuts, but Obama's support shows that corporate tax reform is a legitimate bipartisan goal. Congress also wanted to cut taxes on business income that's not taxed at the corporate level. Over 90% of America's businesses are pass-through entities. And most economists will tell you that growing private businesses create more new jobs than mature publicly traded companies. And also cutting corporate tax rates without cutting pass-through individual rates would distort the economy by pushing business owners to reorganize their entities just for the tax breaks. And finally, Congress wanted to lower tax rates overall. They knew it would be politically tough to pass corporate reform without promising something to the people who work at those corporations. But here's the problem. Cutting all those taxes costs money. So Congress had to come up with what they all pay fors to make up for most of that lost revenue. They did it in two ways. First, they tightened or eliminated many of the deductions we've come to take for granted over the years, such as personal exemptions, state and local taxes, mortgage interest, and the like. Second, and maybe more important, they phased out most of the personal changes starting in the year 2026. So remember the fiscal cliff we went over back in 2013? Well, don't be surprised if we find ourselves facing another one in 2025. Keep in mind as we talk about this that there are four main categories of strategies you can use to cut your tax bill. There's the timing-based strategies, such as using a 401k deferral to shift today's tax bill to tomorrow. There's income shifting strategies, where you move taxable income to lower bracket taxpayers like your children. There's code-based strategies, For example, like Section 105B, that may let you deduct your family's medical bills as a business expense. Oh, excuse me, I apologize. I have a little tickle in my throat. And lastly, we have a product-based strategy like separate managed accounts and insurance. So you'll find that most of the new laws changes fall under the code-based strategy. The first thing you need to know is that there are, again, 4 different tax classifications for businesses. We have our sole proprietorships, partnerships, S corporations, and C corporations. Now you may be looking at this list and thinking, hey, wait a minute, my business is an LLC. Where do LLCs fall on the list? The answer is that an LLC is a type of entity that's formed under state law, but it's not a tax classification. LLCs can actually choose to be taxed as whatever entity they want. So a single member LLC with just one owner is assumed to be disregarded and is taxed as a sole proprietor. But that same single member LLC can also elect to be treated as an S Corp or even as a C Corp. And likewise, a multiple member LLC with 2 or more owners will be taxed as a partnership. But those same owners can elect to be taxed as an S Corp or even as a C Corp. So regardless of which entity you choose, the basic process works the same. So first, add up your income from all sources. This includes your sales or service income, all of your subscription revenue, or anything else your customers pay you throughout the year. It also includes investment income from bank accounts or investment portfolios the company owns. Next, you're going to subtract your cash expenses, like your cost of goods, salaries and wages, your rent and office expenses, interest, employee benefits, and the like. And then you're going to subtract your non-cash expenses. And this includes depreciation on your capital assets or real estate and equipment. And it also includes any type of amortization of your intangible assets like your startup expenses and goodwill. Once you have a final bottom line result, you either pay tax on it at the corporate level if you are a C Corp, or you'll pass it through directly to the owners if you're taxed as a sole proprietorship, partnership, or S Corp. So sole proprietorships, by definition, have just one owner. So they report their income on Schedule C, directly on that owner's personal return. Partnerships and S corporations give each owner Schedule K1, reporting their share of the income and expenses. And lastly, C corporations can take tax credits directly on their own return, whereas proprietorships, partnerships, and S corporations use the K1 to pass through those credits to the owners. So let's take a look at corporate tax rates first. So for 2017, the corporate tax system had 3 rates: 15% on the first $50,000 of income, 25% on the next $50,000, and 35% on anything above that. However, the tables, if you see the table on the screen, actually phase out the benefit of the lower 15% and 25% rates as the corporation's taxable income goes up. So what we actually ended up with was this ridiculous 8-layer cake that repeated the 34% and 35% brackets twice as you moved up the ladder. And for some reason, that wasn't complicated enough. So the code actually offered a few more hurdles to jump. They distinguished what is called personal service corporations, and these are corporations that are engaged in accounting, science, architecture, consulting, engineering, any medical, law, And all of these corporations have to pay a flat rate of 35%. The goal here was to keep personal service professionals from avoiding tax by leaving it inside their corporations. There was also a separate category called personal holding companies. And these are corporations where more than 50% of the value of the outstanding stock is owned directly by five or fewer individuals. And more than 60% of the income to the corporation is earned from passive sources. So like interest, dividends, rents. There was also a 20% corporate alternative minimum tax, or AMT. And then also, the IRS didn't want you sitting like Scrooge McDuck on a giant pile of cash inside your corporation. So there was, they force you to distribute as a dividend any money in excess of $250,000. So, and if you didn't, there was an additional tax of 20%. So under the new law, things get considerably easier. There's now a single flat rate of 21% that applies from your first dollar of income to your very last dollar of income. And there's more good news. The new law eliminates the personal service company tax, and it eliminates the alternative minimum tax. The new rules will make C corporations far more valuable to business owners and even investors. So let's take a look at some examples. Say you have an older owner with taxable income. Your personal taxable income is at the 22% bracket or above. It would be better to earn income inside a C corporation, pay tax at this 21% flat rate, and you leave the net profit inside the corporation until death. And at that time, when the corporation will acquire a step-up basis and it can be liquidated and distributed tax-free to your beneficiaries. Another scenario is a highly paid professional who has incorporated their practice can either take income in the form of salary, which could be taxed at rates as high as 40%, or they can leave profits inside the corporation to be taxed at 21%, and then take the difference as a dividend, which is actually taxed at a lower 23%. So it comes out better to leave it in the corporation. You can also use a C corporation as an alternative to a qualified retirement plan. So basically, you would leave all of the earnings in the corporation, and you would withdraw them in a later year when you're in a lower tax bracket. So when you retire. If you're nearing the end of your career and don't need the income for current living expenses, you can even leave them inside the corporation until your death. And again, at that point, your beneficiaries will enjoy a stepped-up basis on those assets and can withdraw all the accumulated funds tax-free. So let's talk about the new law's biggest change for most business owners. And this is a new kind of income. And this is specifically for pass-through businesses. So this, again, your sole proprietorships, your partnerships, and your S-corps. The tax code has always recognized there are different kinds of income, and each of those incomes are treated differently. So first, we have our ordinary income, and this is what you earn from your work or your business. If you earn a salary from a job, and your spouse loses money in a business, for example, you can net those amounts against each other. Ordinary income is taxed at ordinary rates. Next, we have investment income. And this is income that you earn from your portfolio. And some of it, like taxable interest income, is taxed at ordinary income rates. But there are different kinds of investment income that are taxed at different rates. You might be familiar with, qualified corporate dividends, for example, are taxed at special rates. Even long-term capital gains from property and investments, they're capped at 20% capital gains tax. And, also if you have capital losses in a year, you can subtract them from your capital gains. So again, it's matching the type of income, and the loss offsets the income, but you have to match the type of income. So in in the mid 1980s, the taxpayers had actually figured out a way around investment income. They discovered that they could use borrowed money to increase their basis in investments like real estate and equipment leasing and write off huge paper losses. And they were able to use these losses to offset their ordinary income from salaries and businesses. And this was great for taxpayers, of course, but it wasn't so good for the US Treasury. So in 1986, Congress created a new category of income, and this is called passive income, where you don't materially participate. So again, the 1986 rule said that you can write off passive losses against passive income, but you can't write it off against ordinary income or investment income. So again, it's matching the type of income, the losses and the income. You have to match your bucket. So Congress, with this new tax act, created a fourth kind of income, and it's called qualified business income. This is what's new, qualified business income. And here's why they needed to do that. The new tax law lowered the top tax on C corporation income, as we saw, from 35% to 21%. Previously, the top tax rate on pass-through businesses was 37%. So to equalize the tax treatment between taxable and pass-through businesses, the act had to create a new category of income. And this qualified business income, so the new tax act lets you deduct 20% of that income, which is calculated on an activity by activity basis. So this is where it gets a little technical, but bear with me. So qualified business income includes net business income, again, not from C corps. This is only from sole proprietorships, partnerships, and S corps, all of your pass-through entities. If your 2018 taxable income, for example, this is your personal taxable income, because again, this is pass-through businesses. So if your personal taxable income, after all of your adjustments, after you take the itemized deductions, after you take, or the standard deduction, if your income is over $157,000 or $315,000 for joint filers, then this 20% deduction starts to get phased out. And how it gets phased out is you're either going to take 50% of your W-2 wage, or you're going to take 25% of your wage plus 2.5% of the cost of all of your property that you purchase and placed in service in the year. So I do have to mention, I'll go through this again. So if your taxable income is less than this $157,000 or $315,000, then you don't have to worry. You don't get phased out. You'll get the full 20% deduction from your qualified business income. However, if your income is over this $157,000 or over $315,000, then this 20% deduction starts to get phased out. And the question is, how much does it get phased out? And that's where the calculation is determined. It's either going to be 50% of your W-2 wages, or it's going to be 25% of your W-2 wages plus 2.5% of the cost of all the property that you purchased that year. And on a side note, I do have to mention that there's a separate category called specified service business. And these businesses are the medicine, the law, financial services, consulting, any business that relies on the reputation or skill of, one of its employees. So these type of businesses, if you fall in this category, the deduction phases out slightly different. It's basically different thresholds, different dollar amounts. So you just have to keep this in mind if you are in any of these fields. So the overall qualified business income deduction is limited to 20% of your taxable income. If your qualified business income for the year is below zero, you can carry the loss forward to the next taxable year. So the new rules actually suggest several ways to maximize this deduction. And honestly, the more time the tax attorneys and accountants, the more time we spend looking at these rules, the more ideas we'll come up with. When critics of the tax bill say it will encourage gaming the system, this is the provision they're talking about. In some cases, qualified business income this deduction can even turn pre-tax losses into after-tax gains. So some things to consider. If you currently operate a specified service business as a sole proprietor or as a partner, and you have few or even no employees, and your taxable income is over this threshold, this $157,000, then you might want to consider establishing an S Corp and paying yourself a W-2 wage so that you can get the full benefit of this 20% deduction. If your business only involves some personal services, you could consider segregating the non-service income into a separate activity to maximize the deduction. Let's see, if your business occupies real estate that you own, you could consider separating that real estate into a separate activity and paying the highest reasonable rent to that entity to qualify for the deduction. If your business utilizes independent contractors, consider making them W-2 employees to maximize the deduction. Of course, if those employees are paying attention to the law, they may prefer to keep that status. So again, we're looking at how this deduction is calculated, and from there we can incorporate different tax planning strategies to really maximize this deduction for your business. Another alternative is you can quit your job. If you're working for the man, you're probably a little bit envious of your self-employed peers. They could be doing the exact same work as you and paying tax on 20% less income just because they run their own business. No, but seriously, if there's a way to renegotiate your relationship with your employer to become an independent contractor, if so, you'll immediately recharacterize your income in a way to take advantage of these new rules, as well as other planning opportunities available to business owners. And some final notes on this whole qualified business income deduction. I realize this is going to sound a little bit self-serving, but this really isn't a do-it-yourself planning. Just because you can buy a tool to do something yourself instead of hiring a professional to use the tool doesn't mean you should. And you want to hear something funny? Here's what the Congressional Conference Committee responsible for the final draft of the qualified business income, what they said in their report was, and I quote, It should not result in an increase in disputes with the IRS, nor will regulatory guidance be necessary to implement this decision. I thought that was quite funny. I'll stop here for today. You saw when we talk about a couple case studies, how the new law may save you, will save you some money. But there are a lot of moving parts, especially for business owners. And there are a lot of opportunities you have to plan for to take advantage of. So that's where we come in. We offer true proactive tax planning to help you make the most of the new tax law and catch up on opportunities you may have missed under existing law too. And, the process works like going to the doctor. If you're sick, the doctor starts with the diagnosis, what's causing the pain, then he prescribes a solution. Maybe it's a prescription or surgery or physical therapy. And then finally, someone fills that prescription. So, we work the same way. We start by sitting down with you for a free tax analysis where we review your returns to find any mistakes or missed opportunities. And then we prescribe the solution to stop that bleeding. And maybe that means restructuring your business entity or, rescuing any, lost deductions that we find. And then finally, we fill those prescriptions. So in some cases, we do it. In others, we'll bring in a network of specialty vendors to help you implement these strategies. I want to thank you for your time today. I'm sorry, I know we went a little bit over. But if you have any questions, feel free to email us at info@smarttaxhawaii.com. And again, I thank you for your time today, and I look forward to next week where I'll be going into part 2 with the business impact of the new tax law. Thank you and have a great week.